So hello everybody, continue on actually the last part of chapter 4. Now we're discussing mid-year acquisitions and sales of investment. If we have an acquisition, so the examples that were provided previously in your textbook involved purchasing the subsidiary either on the first day of the year or the last day of the year in case of chapter 2. But it might be situations where we purchase the subsidiary in the middle of the year or any other day other than the first or the last. So if that's the case, then you have to remember that we're only going to report the subsidiaries activity or financial statements. We're only going to consolidate our financial statements from the point that we acquired that subsidiary. So in that case, if we're provided with their annual information, annual revenues, annual expenses, we're going to have to prorate those from the time to reflect the time that from the time that we acquired the subsidiary through the end of the year. Our next objective deals with the sale of a subsidiary. So what we need to pay attention here to is what happens after the sale. So is after the sale, we still have control or we have lost control. So maybe we sold too many shares and now we own less than the 50% requirement, or we still have more than 50%, we still retain control. So how are we going to report that on our financial statements? So in the first example, we retain control. If we retain control, in this case, we have Adam's company owns 100% of Smith. Smith has 25,000 voting shares, which Adam owns. And Adam sells 5,000 of these 25,000 shares. So basically, they sold a 20%. So now they own 80% after the sale, and in that case, they still retain control. In this case, the investment had a beginning balance. So this sales took place on January 1st, 2018. On that date, the investment had a balance of 750,000. So 20% of the 750,000 is the basis of this portion that was sold. So we sold it for 165,000. This is the basis, so we're going to reduce our investment in subsidiary because we no longer own this 20%. And so now we are increasing our additional paid-in capital by the 15,000. If the instance that we sell too many shares and now we no longer have control in this company, in this example, we sold 20,000 shares, meaning Adams, of Smith. Smith had 25,000 shares. So this means that our basis now is 600,000, or the basis of the portion that we sold in Smith is 600,000. We sold those 20,000 shares for 675. So we're realizing a gain of 75,000. In the previous slide, we didn't record a gain. We actually increased additional paid-in capital because we're saying this is an additional contribution from the non-controlling interest. But in this case, since we no longer have control, now we're recognizing a gain. So it will be treated just like a sale of any other investment. And so the other portion, since we lost control, is that we're going to have to reassess the value of our investment. So how do we reassess the value? We basically know that someone pays $675,000 to acquire 20,000 shares. So that's $33.75 per share. and we still own 5,000 shares, so that means that the value of our investment should be 168,750, but it is 150,000 in our books, Adam's books, and that means that we need to increase this investment by the 18,750. So we see here, we debit the investment. In that case, we increase it, and we're recognizing a gain on revaluation of this investment of 18,750. And that concludes, actually I have one more slide which refers to the FASB codification. I just wanted to highlight topic 805, which relates to business combinations, and topic 810, which relates to consolidations under US GAAP. And this concludes our presentation for chapter 4.